Understanding market corrections. When investing in the stock market, it is important to properly understand the investment concept of a market correction, especially as it's distinguished from a bear market. A market correction is a significant but typically short-lived decline in the price of a security, asset, or market index. In the stock market, a market correction is commonly defined as a drop of 10% or more from its most recent peak. However, the decline is generally less than 20%, as a drop of 20% or more is classified as a bear market. The key aspects of a market correction can be identified as A. Magnitude. A fall of at least 10% but less than 20% from a recent high. Drops smaller than 10% are often referred to as dips or pullbacks. B. Speed. Corrections tend to be relatively rapid and can occur over a few days, weeks, or a couple of months. They are often sharper than bear markets. C. Duration. On average, market corrections are shorter in duration compared to bear markets. Historically, the recovery period after a correction can range from a few months to around a year. D. Scope. A correction can affect individual stocks, specific sectors, or the broader market indices like the S&P 500, Dow Jones Industrial Average, or Nasdaq Composite. E. Investor sentiment. Market corrections often reflect a shift in investor sentiment from optimism to increased caution or pessimism. This can lead to widespread selling pressure. F. Retrospective measurement. Corrections are usually measured retrospectively from the recent high to the lowest closing price during the decline. The trigger for a market correction can arise from a variety of factors, often in combination, including A. Economic factors. Concerns about slowing economic growth, rising inflation, increasing interest rates, changes in Federal Reserve policy, or disappointing economic data, like job numbers or manufacturing reports, can trigger a correction. B. Political and geopolitical events. Uncertainty arising from elections, policy changes, trade disputes, international conflicts, or geopolitical instability can spook investors and lead to sell-offs. C. Market sentiment. If the market has experienced a prolonged period of strong gains and valuations appear high, overbought conditions, investors may become more cautious and any negative news can trigger a correction as they take profits. Fear of missing out can also lead to unsustainable price increases that eventually need correction. D. Earnings reports. Weaker than expected earnings reports from major companies or negative future guidance can lead to a decline in stock prices and potentially trigger a broader market correction. E. Unforeseen events and shocks. Unexpected events like pandemics, natural disasters, or major corporate scandals can create uncertainty and lead to market corrections. F. Technical factors. Sometimes a correction can occur due to technical reasons, such as the breaking of key support levels in market indices or individual stocks, triggering automated selling. While market corrections can be unsettling for investors due to the decline in asset values, they are considered an important and often healthy part of the market cycle, as they can serve to facilitate 1. Valuation reset. During prolonged bull markets, periods of rising prices, asset valuations can become inflated, sometimes exceeding their fundamental worth. A correction helps bring prices back down to more reasonable or sustainable levels, correcting these overvaluations. 2. Preventing bubbles. By deflating asset prices before they become severely overvalued, corrections can help prevent the formation of larger, more destructive asset bubbles that could lead to more catastrophic crashes. 3. Shaking out excess speculation. Rapidly rising markets can attract speculative activity based on hype rather than fundamentals. Corrections tend to weed out some of the speculation, leaving more fundamentally sound investments. 4. Creating buying opportunities. For long-term investors with cash on hand, a correction presents an opportunity to buy quality assets at lower prices. This can enhance potential future returns when the market recovers. 5. Testing investor sentiment. Corrections test the conviction of investors. Do they panic and sell, or do they hold or even buy more? This shift in sentiment is a natural part of market dynamics. 6. Part of the natural cycle. Markets don't go up in straight lines forever. Corrections are a normal fluctuation within the larger upward trend of the market over the long term. They represent a pause or pullback that is expected over time. 7. Setting the stage for future growth. By clearing out excesses and resetting valuations, a correction can lay a healthier foundation for the next phase of market growth. Think of it as letting off steam before the market can resume a more sustainable advance. 8. Highlighting risk. Corrections serve as a crucial reminder to investors that markets carry risk and that prices can go down as well as up. This reinforces the importance of diversification and aligning investments with one's risk tolerance and time horizon. In essence, while painful in the short term, market corrections help maintain market efficiency and can contribute to more stable and sustainable long-term growth. They are a necessary recalibration mechanism in dynamic financial markets. To learn how our law firm's corporate and financing legal practices can advance your own financial objectives, contact us today. Thank you.